It's 10:12 a.m. Eastern Standard Time, March 14th, and the COMEX silver futures market just broke. Not cracked, broke. The spread between paper futures and physical metal has exploded to 450. Normal trading conditions show spreads around 20 cents. Right now, dealers are quoting physical bars at $27.50 over the COMEX paper price of $23. That's a 19% discrepancy between what the screen says silver costs and what you'll actually pay to hold it in your hand. Premiums on serialized physical bars have spiked to $39,000 per ounce. Meanwhile, COMEX futures traders are watching their screens show relative calm, minor fluctuations, orderly book depth, nothing alarming. But dealer inventories across 3 continents are being drained in real time. Physical silver demand is surging while paper contracts trade in their own isolated reality. This isn't volatility. This is systemic breakdown unfolding before your eyes. At 10:12 a.m. Eastern, silver futures dropped 150 in a single violent print. Trading volume spiked to 75% of average daily volume in a 30-minute window. The spread, that critical gap between what paper traders see and what physical buyers pay, jumped from 20 cents to $4.50, a 2,250% increase. COMEX screens showed the paper market cooling down, order flow normalizing, spreads tightening back toward historical norms. But refresh any major dealer website and you'd see a different story. Out of stock notices plastered across serialized bar listings. American Silver Eagles, gone. Canadian Maples, backordered 6 weeks. Serialized 10-ounce bars, none available. The 2011 silver squeeze saw paper pricing diverge from physical metal for weeks. Premiums climbed, delivery delays stretched, and the mechanism that's supposed to keep these markets aligned simply stopped working. Today's move makes 2011 look like a practice run. This isn't just a sell-off. This is the market breaking down, and here's why. By 10:30 a.m., the Shanghai physical silver market opened with a premium 25% above COMEX futures. Western paper showed $23. Asian physical traded at $29. That's a $6 gap across 2 markets that are supposed to arbitrage each other into alignment within minutes. Arbitrage, the mechanism where traders buy cheap in one market and sell expensive in another until prices converge, was failing. Physical metal scarcity in Asia wasn't being solved by shipping metal from the West because there wasn't enough physical metal in the West to ship. The textbook mechanism that's supposed to prevent exactly this kind of price divergence had stopped functioning. Dealers in Hong Kong, Singapore, and Mumbai reported inventory depletion rates of 40% in 2 hours. No restock scheduled, no estimated time of arrival on new shipments. Just empty vaults and order books full of buyers willing to pay any premium to secure physical allocation. The spread wasn't narrowing, it was widening. At 10:45 a.m. Eastern, COMEX warehouse reports updated. Total registered silver inventory, the portion available for delivery against futures contracts, dropped 10% in 1 hour. Not 10% of monthly drawdown, 10% of total stock in 60 minutes. Dealers posted status updates across their sites. Inventory depleted. No serialized bars available. Cash orders only, no metal. The physical market wasn't just tight, it was locked. Meanwhile, COMEX paper futures continued trading in their orderly electronic universe, screens showing bid-ask spreads of 2 cents, order flow balanced, no delivery alarms flashing on trader dashboards. If you're holding paper silver, an ETF, an unallocated account, a futures contract, you might already be trapped. The physical market is where the real action is. The paper market is where the illusion lives, and that illusion is about to cost a lot of people a lot of money. What you don't know yet is, this is just the beginning of a much bigger problem. By 11 a.m., the COMEX forward curve began showing backwardation, a condition where near-term futures contracts trade at higher prices than longer-dated contracts. In normal markets, holding physical metal has costs: storage, insurance, transport. So future prices should trade at a premium to spot prices to compensate holders. Backwardation flips that logic. It signals that the market values immediate delivery over future delivery. It means physical metal right now is worth more than a promise of metal later. Silver backwardation deepened to 12% within 90 minutes. Historically, backwardation this severe appears during supply crises, delivery failures, or systemic stress. The last time silver backwardation reached double digits was during the 2011 squeeze, and it took weeks to build. Today, it built in hours. Traders holding short positions, bets that silver would fall, were now facing forced delivery obligations into a market where physical metal was vanishing. The paper market still showed calm, the physical market showed chaos, and the gap between them was growing. At 11:15 a.m., Shanghai's afternoon session opened with premiums climbing to 30% over COMEX. Western dealers reported website crashes from traffic overload, buyers frantically attempting to lock in orders before inventory zeroed out completely. On dealer chat forums, frustrated buyers posted screenshots. Shopping carts filled, checkout attempted. Inventory error messages returned. Sold out. No ETA, the dealer site read. Major bullion dealers in the U.S. suspended online ordering entirely, switching to phone-only sales with verbal confirmation of inventory availability before accepting payment. That's not normal market operations. That's rationing. Meanwhile, institutional investors holding paper-silver positions were beginning to realize the mathematical trap they were in. If you hold a futures contract promising delivery of physical silver, you have two choices at expiration: take delivery or settle in cash. Taking delivery requires physical metal to exist in deliverable form. Right now, that metal was disappearing. Cash settlement means you close your position at the paper price, missing the entire premium surge happening in the physical market. By 11:45 a.m., lease rates for physical silver, the cost to borrow metal for short-term delivery, spiked to 8% annualized. Normal lease rates hover near zero. 8% annualized means the market is screaming for immediate physical supply, and holders of physical metal are demanding extraordinary compensation to lend it out. This is how market stress announces itself in observable terms. Lease rates are the price of bridging the gap between paper promises and physical reality. When they spike, it means that gap has become unbridgeable under normal terms. Large institutional shorts, hedge funds, market makers, banks holding net short positions in silver futures were now facing a brutal calculation. To cover their short positions, they needed to buy futures contracts. But buying futures contracts doesn't deliver physical metal. It delivers more paper. And the paper market was trading at a massive discount to the physical market they'd eventually need to access if delivery was demanded. They were trapped in a paper cage while the metal they'd promised to deliver was evaporating. At 12:00 p.m. Eastern, volume data showed COMEX silver futures trading at 120% of average daily volume, with 4 hours still remaining in the session. That kind of volume surge signals repositioning, traders closing positions, opening hedges, scrambling to adjust exposure before a major move. But here's what the volume data wasn't showing: physical market transactions. Paper contracts were changing hands electronically at high speed. Physical metal wasn't moving because there wasn't enough of it to move. Dealers in London, Zurich, and New York reported identical inventory statuses, single-digit quantities remaining on serialized products, no restocks scheduled, premiums rising hourly. The arbitrage mechanism that's supposed to pull metal from low-premium markets into high-premium markets wasn't functioning because there were no low-premium markets left. Every physical market on the planet was showing scarcity signals simultaneously. The paper market could trade 1 million contracts. It didn't matter. You can't deliver paper to someone demanding metal, and that was before the lease rates flipped. By 12:30 p.m., geopolitical tensions added fuel to an already burning market. Sanctions targeting major silver exporting nations disrupted global supply lines, tightening physical availability further. Russia and Mexico, two of the world's largest silver producers, faced export restrictions that removed millions of ounces from the accessible supply pool. Physical silver doesn't teleport. It ships on trucks, planes, and boats through customs checkpoints and regulatory jurisdictions. When geopolitical barriers go up, physical supply chains break down. Meanwhile, central banks and sovereign wealth funds were quietly accumulating physical silver, treating it as a monetary hedge rather than an industrial commodity. These aren't retail buyers placing online orders. These are institutional entities moving tonnage through private channels, locking up supply before it ever reaches public markets. Premiums in Asia climbed to 35% over COMEX. If you're still betting on paper, you're in for a painful reality check. Physical is the only game left. This system is close to failure. Keep watching. The worst is yet to come. At 12:15 p.m. Eastern, the COMEX settlement deadline began its countdown. March futures contracts were approaching expiration, and traders holding long positions, bets that silver would rise, had to decide: demand physical delivery or settle in cash. Backwardation deepened to 18%, a clear signal that the market was pricing in forced delivery stress. Here's the trap. If you demand delivery, you need the counterparty, the short seller who sold you the contract, to actually have physical metal to deliver. Right now, that metal didn't exist in sufficient quantities. If you settle in cash, you close your position at the paper price, forfeiting the massive premium available in the physical market. Either way, someone loses. Institutions holding large short positions were now under severe pressure. Delivering physical metal into this market meant buying it at premiums they never anticipated. Settling in cash meant paying out on contracts at prices disconnected from physical reality. Gamma pressure, the sensitivity of options positions to rapid price moves, amplified the stress, forcing dealers to hedge dynamically in a market with vanishing liquidity. By 12:45 p.m., dealer reports showed total inventory depletion across major distribution channels. American Silver Eagles, Canadian Maples, Austrian Philharmonics, serialized 10-ounce bars, every major product category displayed the same status: out of stock, not low inventory, not back-ordered, out of stock. Mints couldn't produce fast enough to meet demand. Refiners couldn't source enough raw material to keep production lines running at capacity. The physical silver market had hit a supply wall, and demand was still accelerating. Meanwhile, paper silver ETFs showed stable share prices, calm trading volumes, no redemption spikes. The disconnect was complete. Paper markets operated in their abstract electronic realm, pricing silver as if supply and demand balanced normally. Physical markets operated in tangible reality, pricing silver as if it might not be available at any price soon. The spread between COMEX futures and physical metal reached $5. That's not a trading opportunity, that's a market failure signal. And it was about to get worse. At 1:04 p.m. Eastern, COMEX expiry hit. Traders holding long positions demanding physical delivery faced cash settlement as the only viable option. The exchange simply didn't have enough registered inventory to meet delivery demands at current contract volumes. Cash settlement meant closing positions at $23, the paper price, while physical metal traded at $28 in accessible markets. That $5 gap represented the cost of the illusion. Paper traders had been operating under the assumption that paper and physical were interchangeable, that contracts could convert to metal on demand, that the system was designed to deliver. Today proved otherwise. The paper market had decoupled from physical reality, and the decoupling was accelerating. Institutional shorts trapped with large positions faced catastrophic losses. Covering their shorts required buying back contracts at elevated prices, while simultaneously confronting the reality that those contracts might never convert to deliverable metal. The math was brutal. The consequences were inevitable. You're about to see why this breakdown is irreversible. By 1:30 p.m., dealer websites displayed uniform messages across the industry. No serialized bars available, no estimated restock dates, premiums at historical highs for the limited inventory remaining. Phone lines to major dealers were jammed, wait times exceeding 2 hours, customers desperate to secure any physical allocation before prices climbed further or supply vanished entirely. This wasn't panic buying, this was informed repositioning. Sophisticated investors who understood the paper-physical disconnect were moving capital from paper exposure to physical holdings, while physical was still theoretically available. The spread between COMEX futures and physical metal had widened to $5.50. Every dollar of spread widening represented another layer of systemic stress, another proof point that the arbitrage mechanism had permanently broken. Production constraints couldn't be solved overnight. Mining output operates on geological timelines. Refining capacity doesn't scale instantly. Physical silver supply is inelastic in the short term, and short-term demand had just gone exponential. Watch the spread. If it hits $8, you'll know the squeeze is about to explode. Right now, it's sitting at $5.50, up from 90 cents at market open. That's a trajectory, not a fluctuation. Inventory levels across major dealers remain at zero for serialized products. Premiums on available inventory, coins, rounds, smaller bars, are holding at 30 to 40% over paper prices. Backwardation is locked at 18%, signaling that the market expects delivery stress to intensify, not resolve. Lease rates remain elevated at 8% annualized, confirming that physical holders are demanding extreme compensation to lend metal into this market. The geopolitical supply disruptions aren't temporary. The institutional accumulation isn't stopping. The paper market can't manufacture physical metal, and the physical market can't meet demand at current prices. The spread that opened at 90 cents this morning is now $5.50. The system that was supposed to arbitrage it never showed up. This is what irreversible looks like.